Good afternoon, everyone. Welcome to Questrade's webinar series. Thank you so much for joining us. My name is John, and I'm your host from the Questrade education team. Joining me shortly are our very special guests and presenters. But before we get started, let's quickly go through our agenda for the event and some important notes along with a disclaimer. So here's our agenda for today. We'll start with some important event details and disclaimers, then move right into a quick introduction of our speakers today. We'll be joined by Kevin Davitt from the NASDAQ to start us off, and he'll walk us through tracking and trading volatility indexes. The first session will last approximately 40 to 45 minutes, and we'll wrap up with our first live Q&A period. Right around the halfway mark, we'll have a short break or intermission, so feel free to get up, stretch, or grab something to eat or drink before the second half of the event. The second part of our webinar today will be presented by our friends Jessica Inskip and Tony Zhang from OptionsPlay. They'll discuss more hands-on options education, explaining ETF versus index options, strategies for volatile markets, and much more. Lastly, we'll wrap up with another live question and answer period to help close out today's event. All right, some housekeeping. So today's session will be recorded, and we'll have the on-demand version available early next week. If you have to duck out early or would like to rewatch an important section, we've got you covered. Keep an eye on your email inbox for the recording. And if you have any questions during the presentation, please type them into the Q&A window available at the bottom of your Zoom interface. Our agents can help answer simpler questions throughout the presentation, and we'll be hosting 2 longer question and answer periods during the webinar today. And if you're having technical issues or have general questions about Questrade or trading, please feel free to message one of our Questrade support agents via direct chat. And here's our quick disclaimer. Please remember that the information conveyed in this webinar is for informational educational purposes only and does not constitute advice or recommendations by Questrade. Now, without further ado, I'd like to introduce our first guest speaker today. Kevin Davitt is the head of index options content at NASDAQ and brings years of options education experience to the table from his time spent at CBOE Global Markets. Prior to his exchange work, Kevin traded index, equity, and commodity futures and options as a market maker at a variety of well-known firms. We're very excited to have him here today to present. So without further ado, I'd like to pass things off for part 1 of our presentation. Thanks again, Kevin. Take it away.
Thank you for that, and be patient while I try to take it away from you from a visual standpoint. John, if you would just confirm that you're seeing the first part of my presentation, looks like we're good. All right, so first off, thank all of you for joining us this afternoon. I genuinely appreciate that introduction, and thinking about presentations like these, I want the group to like me. So I think about the audience, and I want you to know this. My wife is a competitive hockey player. She was the first girl to play on Team Illinois back years ago, and then she played at some fancy East Coast high school and college. So take that into account, and hopefully you enjoy this. I know I'm painting with a broad brush with the Canadian audience here. All right, as John mentioned, I'm Kevin Davitt. I'm head of index options content at NASDAQ, and in the next 45 minutes or so, I am going to focus on the NASDAQ index as well as the ecosystem, and I have air quotes there, that's growing around it. Now, on the off chance that you've ever listened to a past presentation that I've done, you might know that I'm a fan of history, kind of generally, and market specific. And I'm also a fan of words. I enjoy writing. I like thinking about words. And in my opinion, ecosystem is one of those words that gets thrown around kind of too frequently these days, which I think can kind of denigrate it. It's become one of those corporate buzzwords in that it can be a catch-all, and that means everything or nothing. So we're going to talk, like John mentioned, specifically about what the NASDAQ-100 Index is. So at the core of this broader ecosystem is a collection of publicly traded companies, 100 of the largest non-financial companies listed on NASDAQ exchanges. Many of those companies are household names. You likely know them well. Now, the constantly evolving byproducts of that index ecosystem includes products like futures, exchange-traded funds, index options, and more recently, a forward volatility measure in the form of VOLQ. There is a VOLQ index. There are also VOLQ futures and options, and I'll mention a bit more about that later. As John mentioned, we're going to leave some time for Q&A, so absolutely engage if anything's unclear. It helps me improve these in the future, and your takeaway is the key here, not me just getting through material. All right, so like all great presentations, it starts with another disclaimer. Now, these are things that a lot of presenters blow through to kind of placate compliance, but generally that's not my style. I love pointing out the risk inherent in every market at all points in time. There are unique risks associated with futures and options markets, with derivatives. And in my years of experience, I think the people that key in on first and foremost the risk in any given idea as opposed to the potential reward tend to be more successful, and that kind of runs counter to how our brains want to work when we imagine things working out swimmingly. Now, it is worth pointing out at the start of something like this that for thousands of years, derivative contracts have been and continue to be used to offset or reduce risk by market participants. Now, they can obviously be used to amplify exposure because of their embedded leverage. So the long and the short of it is that risk exists and options can help you manage your exposure. So like I said, we're going to talk about the NASDAQ-100 index. And from my perspective, I believe that the NASDAQ-100 arguably best exemplifies the U.S. and the global economy in the 21st century. Now, this is coming from someone for years that was focused on the S&P 500, but I believe that to be true, that this index is more representative of where the global economy is these days. When I think about that, we're not talking about General Motors too much now. We focus a lot on Tesla, mostly for good reasons, some bad. Similarly, General Electric isn't what it once was, but Apple has certainly changed the way we live, the way we work. That could be said for Microsoft. It could be said for Amazon. You go on and on, right? So my bigger picture point here is that I would ask you to think about your personal portfolio construction. And beyond that, what companies do you hold, in what size, like as a proportion of the overall, and why? And the reason I ask that is because now I'm going to draw a distinction from a sector and weighting standpoint, but between the two indexes that I've mentioned, the NASDAQ-100 and the S&P 500. So left-hand side, I've highlighted the sector breakdown for the NASDAQ-100 in light blue and the S&P 500 in purple. Now, it seems like we kind of tend to associate the NASDAQ-100 with technology, my second use of air quotes there. And that's an appropriate kind of heuristic. The NASDAQ-100 is about 50% exposed to information technology, which is a very broad swath of companies. And that is double the relative exposure of the S&P 500. So how does that play out? Well, you could kind of look on the right-hand side. In the NASDAQ-100, Apple and Microsoft make up about 23.5% of the index. So the question then becomes, do Apple and Microsoft make up roughly a quarter of your portfolio? I can't answer that for you. The NASDAQ-100 is also heavier on consumer discretionary as far as sectors go. So you might be asking yourself, what kind of companies are those? Consumer discretionary top holdings in the NASDAQ-100, Amazon, Tesla, Starbucks, and Booking.com, which for people that are my age and older might remember as Priceline, with Amazon and Tesla making up a rough total of about 10.5% of the index. Then there's communication services. So what companies are those? Think of Alphabet. I still call it Google. Meta. I still call it Facebook. Comcast, T-Mobile, Netflix. Collectively, they make up about 15% of the index. Now, the NASDAQ-100 index is far less exposed to things like healthcare, industrials, and utilities. So if your portfolio has, I'm just picking names here, like a whole lot of Johnson & Johnson or United Healthcare or Merck, they are less represented in the NASDAQ-100. So that's a kind of quick overview of the sector differences between the two major indices here in the United States. And you might be asking yourself, what's my point? Well, in the next couple of slides, we're going to look at returns, we're going to look at volatility, and we're going to look at a couple of other data points comparing the NASDAQ-100 and the S&P 500. And just like John said earlier, I am not giving advice, but I am of the opinion that if you use index options to hedge portfolio exposure, to gain exposure, looking at your portfolio and knowing whether NASDAQ-100 or the smaller trackers for the index would possibly provide a better offset to your risk is important, particularly in a year like this where there's been a divergence. So, I think about an S&P lower by about 20% year to date as of yesterday, and the NASDAQ-100 off by 30%. So which is more closely tracking your portfolio? Pardon me. And you can see, or I'll illustrate some similar situations on the upside. Just a real basic example, this year a 20%, from January 1st, a 20% out of the money S&P put is now at the money, and a 20% out of the money NASDAQ-100 put is 10% in the money. Now that's a big difference. Okay, so I moved forward visually. And here you have a look at how the NASDAQ-100 has performed relative to the S&P 500 over the past 15 years. NASDAQ-100 this time in purple. And you see the cumulative figures on the right-hand side. This is through like Q2 of this year. So over that time frame, NASDAQ up about 540%. S&P 500, nothing to shake a stick at, 250%. So despite very significant or relatively significant underperformance this year, the cumulative effect is overwhelmingly in favor of the NASDAQ-100. And if you break it down to annual performance, the NASDAQ-100, you can see this in the middle, has averaged 13.6%. That's a positive, versus the S&P's average of a positive 8.9%. But then you think about that nearly 5% annual difference and the compounding effect of that over time, and you see it, on the far right. So the one other thing I want to call attention to on this visual is the kind of light green highlighted part where the annual volatility measures are not dramatically different. So I tend to associate volatility with downside risk. And so do many people, and that makes sense, but annualized vol measures are non-directional, okay? So keep that in mind as we talk through this. You can see positive volatility events and returns. Now, moving ahead again, I talked about ecosystem, right? I mentioned that earlier, and here you can kind of see one of our visual representations of that. So on its own, an index is simply a number that aggregates other numbers or data points. So let's say the NASDAQ-100 benchmark index is roughly 11,500 as of yesterday. An index is not tradable. It's just a number. For tradable products, you have NASDAQ-100 futures, which you see here. There are a couple of different notional sizes there, kind of a big and micro. You have choice. They both track the same exact index. There are options on the futures. There are ETFs like the QQQs, as well as a number of others designed to track it. There are mutual funds designed to track it. This is all part of that ecosystem. And then you have index options, which is where I focus a great deal of my attention. And there are three alternatives for index options, and I'm going to break them down with an analogy here shortly. Now, the last piece of the puzzle, if you're looking on the right-hand side, was added earlier in 2022 with our launch of VOLQ futures and then the options. That's something, again, I'll cover here shortly. John, if there's anything I'm unclear, or you're getting multiple questions at some point about, you can feel free to interrupt me. Otherwise, we'll keep those till the end. All right. So I'm going to talk a little bit more about the construction of this index. On that sort of darker bar, you can see the sectors across the top for the NASDAQ-100. My goal is kind of twofold here. I'm going to dispel that sort of connotation that the NASDAQ-100 is just technology, because it's not. But kind of bigger picture, as I see it, the whole world is kind of tech, no matter the sector. It's simply the way economies have evolved. Now, don't get me wrong, I am not some tech bro, right? Like I grew up with a rotary phone, Blockbuster Video, and limited internet access until after college. So I'm not out there preaching tech. But I am someone that recognizes that tech now directly influences every facet of the global economy. So let's run through a couple examples. And with the things I call attention to, starting on the bottom left, Fiserv. So it falls into consumer discretionary, like Starbucks, another NASDAQ-100 company, but they've grown to become a $65 billion company that helps facilitate payments between you and retailers. It's their technology that makes all sorts of transactions work, and it's part of the index. So the other one I mentioned earlier, Booking.com. One, I think they have good advertisements. They used to be called Priceline, but really it's their technology that helps you book a hotel room or an airplane flight at the lowest rate. Moving again to the right, CSX. You're probably familiar with it. It's a railroad logistics company. They're considered a utility from a sector standpoint. They're part of the NASDAQ-100. What is it about them? Well, their technology plays a huge role in getting, say, canola or oats or other grains or Alberta tar sands from Canada to wherever it's destined for. I think the same could be said for Amgen, which is considered a consumer staple, could be said for Exelon, which is considered a utility. They're both part of the NASDAQ. All these companies are part of the NASDAQ-100, and they all, to a certain extent, rely on technology because it's the way the world works now. Okay. Volatility is a topic I really enjoy. It's another one of those words, kind of like ecosystem, that can mean everything and nothing, right? My perspective, volatility is a constant. The rate of change in a security or an index is going to ebb and flow, but we invest because volatility exists, right? If absent change, there's no incentive to invest. Now, this slide is admittedly a little busy, so I want to explain what you're seeing. Left-hand side, you obviously have calendar years, right? Then you have annual performance for the S&P 500 and the NASDAQ-100. What I focused in on here is that in 12 of the past 15 years, the NASDAQ-100 has outperformed on an annual basis, and that aggregates to a long-term outperformance that you saw on that line chart on the previous slide. Now, in 2020, early in the year, early in pandemic times, the NASDAQ-100 actually dropped less than the S&P 500 in February and March. And by the end of the year, the NASDAQ-100 was up like 49%, and the S&P 500 gained less than 19%. One, that's a huge divergence. But two, it speaks to that difference in volatility, and it can play out on the upside as well, okay? And big picture, I think maybe it's no surprise given this backdrop that we've seen meaningful growth in index options tied to the performance of the NASDAQ-100. In the middle of this visual, you can see the annual correlation between the two indexes, and that ranges between 87% and 95% based on different years. So the translation there is just that the two indexes tend to move similarly over long time frames. Now, differences in performance and correlation are largely explained by components and the unique realized or historical volatility for the index that includes them. So as I mentioned earlier, there's a lot of overlap from a sector perspective and from a specific name perspective, specific company. A lot of individual names are in both, but with different weights. Then you have things like financials, real estate, and energy represented in the S&P 500 that by and large are not constituents of the NASDAQ-100. And in total, that leads to different index volatilities. So on the low end, from a calendar year perspective, 6.7% and 10.3% for the S&P 500, NASDAQ-100, and that was in 2017. Relatively boring year, grind higher, generally good for long-term investors. On the high end, you go back to 2008, where calendar year vol for the S&P was like roughly 41%, and the NASDAQ-100 was just over 46. So that difference, both the constituency, the weighting, and the intervening volatility has yielded a very significant outperformance on the part of the NASDAQ-100. Now, it's possible that that gap shrinks. It has narrowed over the past 10 months. My question to the group is, do you view volatility as a potential positive, or does it have a purely negative connotation? Maybe it changes over the course of this presentation, right? I've done whole presentations kind of just dedicated to that point. But beyond that, the question becomes, like, when you look forward, do you believe the NASDAQ-100 on average will outperform the S&P 500 or whatever index you care about over the time frame that you care about? Because there are index options or options-based strategies that allow you to express a view in a way that can suit your risk appetite, whether they're simple defined risk spreads, something more complex, looking for relative performance, a structured approach like many of the buffered ETFs that have been created in the past few years. My point is that the alternatives are varied, but proactively considering where and why you allocate capital tends to be a good idea, right? And the key word there is proactively, right? Versus being reactionary, which many people are, particularly during years like this one. Okay, 1 second for a little water. Okay, so another kind of somewhat busy chart. We're looking at historical data a different way now. So first off, the gray line, which is barely visible, kind of, it squiggles above that 0% on the X or horizontal axis, shows that the volatility between the two indexes are similar. It's the NASDAQ-100 rolling volatility minus S&P 500 rolling volatility. So except for a brief time in 2009 when U.S. equity markets bottomed, NASDAQ-100 vol is consistently higher. The spread was at its widest in late 2018 and early 2021. The blue line that moves back and forth around that x-axis shows periods of NASDAQ-100 outperformance, and I highlighted those in green. And there are also a few short periods of NASDAQ-100 underperformance when the line is below the axis. Those are highlighted in red. I mentioned earlier that 2020, where the pandemic kind of flipped the script on where and how we worked, the outperformance was absolutely massive there. A great deal of that has been erased as the S&P caught up with the help of energy, in particular, rising. That's a benefit, generally speaking, to the Canadian economy. my point here or on this slide is that for those willing to assume slightly greater realized volatility, that has generally led to outperformance, right? And if you're a believer in capital asset pricing models, they tell you that when you assume more risk, you should be rewarded, but that's not always the case, because the world simply doesn't operate according to models. There are no perfect models. They are helpful, but there's no perfect one. Because why? It's obvious here, but the future is always uncertain. That's never going to change. But index options can help you to manage that exposure or your volatility risk. Now, I want to be fair. I think to have credibility, you have to be fair. You have to point out when, you're not king of the castle, so to speak, right? Maybe you're saying 2008 or 2020 to a certain extent are ancient history. What about when things got weird this year? Well, you can kind of see that here. This visual is from about a month ago for compliance reasons, right? We have to get this approved. But as of this morning or last night's close, NASDAQ-100 is down 30% for the year, and the S&P 500 was down 19.5%, something like this. Now, realized volatility has been relatively high throughout this year. I'm pointing out the obvious to many people. Let's put that in a little greater context with a number. So 6-month historical vol in the NASDAQ-100, roughly around 33%. S&P 500 6-month historical vol, around 24%, right? So that's a fairly big divergence that explains some of the underperformance this year from the NASDAQ-100. Now, keep in mind that longer-term measures, like the 180-day here that I highlight, or something further, 360, whatever, anything longer than that, would move more slowly than a 10-day or a 30-day. Okay, now overall, from an attribution standpoint, the shift in the interest rate environment and the uncertainty, we had a Fed meeting today with a decision just like an hour ago, has impacted the NASDAQ-100 more so than the S&P 500, but the cost of money impacts nearly everything. In capital markets, growth companies have historically been more sensitive to higher rates than what we typically refer to as value companies, and technology firms almost all fall into that growth bucket. Value stocks typically have a much lower vol. They often pay dividends, whereas many growth companies do not. Pardon me. I got a second grader that brings home bugs now and again. And that happened recently. All right. What else? Okay, I don't want to oversimplify a big move in the markets this year, because there's never really a single thing that explains big moves. But understanding how interest rate changes impact different types of firms, I think is helpful, independent of where you put your money. So the question I ask myself is, how much of the tighter monetary policy is already priced in? What would be the impact of a fairly shallow recession, which perhaps we're already in? What about if there's a more prolonged one? Like, are we in the midst of a kind of 2000 to 2003 scenario, for those of us old enough to remember, where growth names consistently underperform? I don't know. It's certainly possible. So it becomes, is that likely, and to what extent? And that's something that you have to decide based on your outlook. But again, taking it back to my key point, are there index option-based strategies that could be used to express your view or to hedge your risk, right? Now, talked about analogies earlier. I talked about this ecosystem, and I talked about sizing, notional sizing, right? Throw around that word, which can be off-putting. Here's the point. There are a variety of index option-based products that all track the NASDAQ-100 index. That's kind of like that key number up here. They all track them. Now, I'm using an example of pop. I am in Chicago. You might call it soda in your parts. It's pop here, right? Specifically, I'm highlighting Pepsi. It happens to be a top 10 holding in the NASDAQ-100. And they happen to announce some surprisingly strong results like a week or two ago. So let's say you go to the store to get Pepsi, to get pop. You have a variety of alternatives, right? But it's all the same Pepsi inside the bottle or the can or whatever form it's delivered in. That is similar to the difference between the index option products that I'm going to highlight. So going from left to right, you have the NDX. That is the large product. The analogy I'm using here is that 30-pack, right? I don't know. Maybe you're having a party. You need a lot of pop, a lot of Pepsi. And in that situation, index, when I put this together, it was 12,000, so slightly higher. Given our index option multiplier of 100, the notional value of one NDX option works out to $1.2 million. That's a big product. If you look at the bottom, generally, who are the end users for that? Bigger firms, pension funds, hedge funds, family offices, some banks that need to offset big chunks of risk with as few contracts as possible. Okay? Move to the middle. Our medium, right? I use the example of a 2-liter, same Pepsi, tracks the same index, right? In this situation, the notional value of one NQX index option is about 12,000, very different is about 240,000, very different than 1.2 million. It's 1/5 of the big contract. Does that make sense? Same pop, different size delivered, okay? Moving all the way to the right, we have XND, NASDAQ-100 Index Options. They're the small ones, all right? The notional value of one XND option is right around 12,000, much more manageable, right? Compared to 1.2 million, it's 1/100th the size of that big index. Hopefully that makes sense because it's important, but thinking about how much, what proportion, what dollar risk you have and what product you use to express that or hedge it is important. And you see clients, end users, and I'm painting with a broad brush here, for each of these different versions or sizes of the product. If there are questions on that, please include them because understanding the distinction is important both to me and to you. Okay, so we've talked a lot about how the S&P 500 and the NASDAQ-100 are similar to a certain extent, how they're distinct from their sector standpoint, their constituent makeup, their realized, often called historical volatilities. And I've described in really broad term the two indexes and their unique makeup and volatilities. But I'm an options guy, and you, if you're listening, you're likely options users. I imagine a variety of you may have traded index options either via an ETF product or possibly a broad-based index. Now, I'm not going to step on Tony and Elizabeth's shoes because they're going to clarify, they're going to make very key distinctions between the benefits there between ETF and index options. But for the rest of the time here, I'm going to focus a bit on this volatility product. We're going to leave some time for questions. So this was kind of the final piece of the NASDAQ index option ecosystem family, this VOLQ index and the tradable products associated with it. Now, keep in mind, before you have a tradable vol product, you need an index. So that spot underlying market. So what is this? The VOLQ index, you can ask Questrade if that's in there. I'm 98% sure it is, but what the ticker is, it's probably VOLQ. It's a dynamic measure, so it changes throughout the day. Dynamic measure of 30-day forward volatility based on at-the-money NASDAQ-100 index options. It is expressed as an annualized number. Some in the audience may be familiar with the VIX Index, which is often considered a barometer for future volatility. Now, VOLQ is similar, but different, in keeping with pretty much all the other points I made when we were comparing the two. So let me explain how. Both use index options to calculate an estimated future volatility. Both use options that expire in roughly 1 month, so kind of the most liquid options. Now, the VIX index is calculated using a wide strip of S&P 500 index options. So it includes a variety of out-of-the-money calls as well as out-of-the-money puts. Another way to put that is that it includes the skew dynamic, which is a characteristic endemic to index options, whereas the VOLQ index is based on at-the-money NASDAQ-100 index options. So not the full strip, the at-the-money options and the options on the NASDAQ-100 as opposed to the S&P 500. So again, index used to calculate are different, NASDAQ versus S&P, and the one that includes a whole bunch of options versus your much more narrow at-the-money options. Okay? Okay. So again, VOLQ index using options that have roughly a month until expiration, right? By and large, your VOLQ measure will be slightly higher than the VIX level because of that difference in historical volatility. It may not always be the case, but that's something to keep in mind. If you are hedging variance, right, the VIX calculation is more appropriate. In my estimation, not too many listeners actively manage variance risk in their portfolio, but I could be wrong. And in my experience, most option users focus on the at-the-money option volatility when they're referencing volatility in general. I think back to when I was on trading floors in Chicago and Philly. If somebody asked where volatility for a given underlying was, I would tell them where the at-the-money vol was trading, not like the way out-of-the-money options. Okay. To be fair, this is not a knock on the VIX index. There's tremendous potential utility, and that goes for both measures. So what might those include? Purely from an information standpoint, a forecast about the future is useful, right? I use a weather app all the time because I want to know what it's likely, what they expect it to be like in the future based on a whole bunch of data. Now, another key attribute of both the VIX and VOLQ is that they historically are negatively correlated to the reference asset. What's that mean, Kevin? VOLQ and VIX tend to move up when the indexes move lower, and vice versa. VOLQ and VIX would likely move down when the indexes move higher. You can't trade either index itself, but there are futures contracts that you could use to assume a directional outlook for forward volatility or offset some risk. And generally speaking, these products, whether it's futures or options, would be used to hedge against like big moves in short order, right? If there are questions on this, please do ask them because it's kind of complex stuff. Now on this visual, I'm going to be really brief because I kind of highlighted this already. Left-hand side shows kind of a whole bunch of options that are included in that VIX index calculation, whereas VOLQ really centers on those at-the-money options. I'll come back to this if there's a bunch of questions in Q&A. But I want to focus a little bit more on how the two have performed this year. Again, the volatility measures tend to move in the same direction because the underlying or reference assets also tend to move in the same direction, right? The underlying assets are both down this year. The vol measures are up. So first off, like I said, VOLQ tends to remain at a premium to VIX. That relates to the higher realized volatility, historically speaking. Both indexes tend to move in the same direction. Now, the NASDAQ-100 has fallen more than the S&P 500, so it's probably not a surprise that VOLQ is up. This is as of a week ago, about 89% on the relative to December 31st of last year, whereas the VIX Index is higher by 73%. Now, I want to make clear what different index levels mean. So a VOLQ reading of 30 says that the at-the-money NASDAQ-100 options with a month until expiration are based on expectations for the NASDAQ-100 to move within a range of plus or minus 30% over the next year. It's a one standard deviation expectation. So for those of you that like statistical terms, if you assume data is normally distributed, it's a 68% confidence interval. My takeaway here for the non-stats types is that it's imperfect, right? There's always uncertainty, but having a forecast based on a market that trades very actively is indicative. It's helpful, right? If I know everyone's expecting it to rain in the next month, I'm going to bring an umbrella. And I look at this in somewhat similar terms, right? Like it's a forecast. There are also tools I can use to potentially hedge my risk. Okay. I focus, like I said, a lot on index options. I've spoken about VOLQ. I spoke about VOLQ launch. Now, this is a point, the distinction, the potential benefits of index options relative to other products like standard equity and ETF options that Tony and Jessica will likely expound upon. There are three key differences. Index options are cash settled as opposed to physically delivering shares of the underlying. Many option traders prefer that. They don't want to manage underlying risk. If you're perfectly fine with that, then perhaps you prefer an ETF option. They are European styled as opposed to American styled. This is no slight to the Canadians. There's no Canadian styling. American style options could be exercised or assigned ahead of expiration. European styled options cannot. It's one less thing to worry about, early assignment. From my perspective, I like that. And then the last one I am not going to get into, one, because I'm not a tax type, but two, I do not know the implications of trading US-based index options in a Canadian account. Perhaps you have a US account, but there are benefits on the US side of the border to using index options as opposed to ETF options. Again, don't take that. That's no advice, but on the US side, that is the case, and it is a motivator for many option traders as they sort of navigate and choose between different alternatives. So I mentioned all sorts of index options. NDX, XND, NQX, all of them track the NASDAQ-100, but they have different sizes, like the Pepsi. I mentioned these benefits, broke it down into three different things. And like I said, the OptionsPlay team is going to elaborate there. I have a bit of a recap here before we go into the Q&A, and you're probably going to ask me what position my wife played or something. Anyway, all right. So going back to the top, my perspective is that the NASDAQ-100 is perhaps the best reflection of the global economy in the 21st century because of its sort of information technology weighting. Could things change dramatically and move away from that? Sure, that's possible. Do I think it's likely? No. I also observe, and in conversation, that more and more portfolios, so what people are holding in what percentage, more of them tend to resemble the makeup of the NASDAQ-100 as opposed to the S&P 500, but only you can determine that by looking at what you hold why, and in what weightings, right? I mentioned different sizes. You have like your Costco or Sam's Club version, that big NDX option with a notional value around 1.2 million. You have the NQX, that's 1/5. So it was our 2-liter example. That's like going to the regular grocery store. Notional value of about 240, 250,000. And then XND, where we're seeing exciting growth. 1/100th of the big one, much more manageable, talking about a $12,000 notional value of one contract. Bigger picture, you have choice for more kind of appropriate or tailored exposure. You also now have a growing number of choices for volatility trading and exposure, and I'm a big fan of that, right? Competition and choice, generally speaking, is a good thing. Keep in mind that from a statistical standpoint, forward volatility measures are non-directional. Even if you don't trade volatility directly, these forward vol estimates, these indices, can be helpful from a signposting standpoint, from an information standpoint. And so putting them on a screen that you look at and allowing that to be one of the tea leaves that you potentially read, they can potentially signal inflection points, right? If volatility starts coming in before you see markets bottom, I find scenarios like that interesting. Or if volatility measures start moving up while the underlying indices are moving higher, that divergence is also very interesting. So again, what you have on your screen can be important and telling and learning opportunities. I covered a lot. We have a whole bunch of resources that would reinforce the points that I made in this middle part of it, where the NASDAQ-100 option part goes. If VOLQ is of particular interest, you can use your favorite search engine there. And then if you have a question for the group, we can be reached at Index Options, no period or underscore or anything, at NASDAQ.com. With that, I'm going to give it like pretty much right on timing cue back to John, and we're going to run through some questions.
Perfect. Thank you so much, Kevin. That was really insightful and an extremely thorough presentation. I'm sure our viewers appreciated your level of detail and are now better equipped to understand volatility indexes and options. So like you mentioned, we're going to move into our live Q&A period. So if you haven't already, please type your questions for us into the Q&A window available at the bottom of your Zoom screen. We'll try to get to as many as we can in the next kind of 5 to 10 minutes. So bear with me for a moment while I scan through the list for a good question to start us off here. And thank you again to my colleagues for helping to answer some of the Questrade related questions early on. All right, we'll start off with a relatively simple one here from a member of the audience. So why is VOLQ down so much today, the index, while the NASDAQ itself is also down? So I know you kind of explained the relationship between the two. And
interesting.
There's this common perception
so you
that
might still be seeing my screen. Let's pop that up. Is it? So it's unchanged. All right. This is it's unchanged on the day, with now it looks like the index down 2.5%, 3%. That's an awesome question. That's a really great question. I commend you. Dustin Johnson, shouldn't you be on tour somewhere? Right? Okay. Ironically, so I grew up caddying, and every now and then I get a chance to go back to where I grew up and caddied. And I got to a couple of years ago, and I got paired with Dustin Johnson and Bo Jackson. For those of you who remember baseball, I've never heard somebody hit a golf ball and make the sound that Dustin Johnson's does. Okay, so if you're not on tour, why is VOLQ down today when the NASDAQ is down so much? Here's, you have, and this is just my opinion, you have markets option markets that priced in a known unknown, which was this Federal Reserve announcement and then the rhetoric about what it looks like going forward. And so when you have that uncertainty, option prices tend to be higher to price in a wider range of potential outcomes. And that's distilled into a forward-looking volatility measure that's higher than it would be absent that uncertainty. Now, at this point, you have that known unknown has become a known to the extent that the next 6 weeks or whatever is clear. And so it was priced in ahead. Now, if that continued, if I continued to see a NASDAQ or an S&P to continue lower and volatility measures not move, not be as responsive as I might expect, from my standpoint, again, not advice, but that can have historically, there have been a handful of situations where that signaled a bottom. And then the inverse is true. If you have indexes like the NASDAQ-100 moving higher and, forward volatility measures also moving higher, when they are positively correlated, either way, it's interesting. Situation where you saw that was late 2017, early 2018. You had markets moving up in January of 2018 quite quickly, and volatility continued to move higher. And then we had a big break. And so those scenarios are unusual. But again, there's not a plus or minus one correlation here. It's somewhere in between. And so making note of that, I think, is great. It's a great question, and I would continue to watch it over the next couple of days.
Awesome. Thank you so much, Kevin. That was a really thorough answer, and I definitely learned a lot about the correlation, whether it's positive or negative, and maybe some things to potentially expect or anticipate kind of coming from. All right. A lot of questions about the Fed announcement, volatility. I think we already touched on that a bit. I mean, the timing was perfect today for the event, I think.
Okay, hang on. Let me pick this one. What are my thoughts on the readings for something like VOLQ in an anomaly environment like March of 2020? Here's my general rule of thumb. Now, not everybody cares about 1 day expected moves, but you can distill these annualized volatility numbers into different time frames that you care about, because volatility is proportionate to the square root of time. Throw that around at your next dinner party, and you might get some glazed over looks, but it's true. Now, there's a simple rule of thumb for distilling those. If you divide by 16, okay? A VOLQ at 16 means that option prices are expecting 1% changes on a day-over-day basis. 32, 2%. 48, 3%. What's next? 64. And we were up near 80, okay? An 80 VIX or an 80 VOLQ means that options are pricing expectations for 5% moves daily. The thing about that is the market was realizing more than that volatility back on a number of days back then. So generally, implied volatility tends to exceed the subsequent realized volatility, and there's opportunity there, but not always. And that 16 rule, based on the square root of, there's 252 trading days roughly in a year, the square root of that is 16. For daily outlooks is something that I consider when I look out and use options to potentially, express a view or offset risk.
Perfect. Thank you so much, Kevin. I think we'll finish with one more just for to keep the time kind of on track here. Sure. Looks like we got some upvotes on this one that's relatively related, and it's more of your personal thoughts even. On 3x leveraged indexes or just leveraged indexes in general. These are going to be leveraged ETF products. Sure. The example that the customer gave was TQQQ.
Okay. So, my answer is going to be twofold here, right? I think, like I said earlier, that choice and alternatives are a good thing. I also believe from 20 plus years of being in this business that not appreciating the power of leverage is one of the most dangerous things, if not the most dangerous thing, that newer traders fall victim to. Leverage is absolutely wonderful when you're right, and it's a nightmare when you're wrong. And so to that end, so long as you understand that products like that, often seek to match the daily returns by some multiple, and you are short-term in nature and fully understand the capital that you're putting at risk, fine. Choice is a good thing, but far too many people will look at a chart and draw some relatively simple conclusion and not understand what's embedded in a product. And I have done it in situations as well. All right. And that's when you can run into some trouble. So that speaks broadly to, maybe I'm just talking my book, that I think education is important, but I mean it sincerely. Understanding the risk inherent in any market and understanding the power of leverage and time frames and the discipline that you need to protect yourself, because things are not always going to go right, is a really key lesson to learn as early as possible.
Absolutely. Thank you so much. And honestly, I've personally been in that situation myself, blindly buying tickers, not maybe understanding the ins and outs of a more complicated derivative product like a leveraged or an inverse ETF. So it's really important to kind of familiarize yourself with the fact sheet, any kind of information you can find online, and really just understand the nature of that leveraged fund or the inverse fund over time as well.
Agreed.
Perfect. Well, thank you everyone for your questions today. Unfortunately, that is all that we have time for at the moment, as we're going to head into the second half of today's event. Before we get started with the second session, we're going to have a short intermission as well. Let me just quickly get everything set up here. Perfect. So we're not going to go for the full 5 minutes just to keep everything on track. We're going to do about a 3-minute intermission here for everybody. So please make sure you don't exit out of the Zoom session, and feel free to keep it running during the intermission so you don't experience any interruptions as well. You can take this time to get up or stretch, and we'll see you all back here shortly to introduce our guests from OptionsPlay. Thank you, everyone. Welcome back, everyone. We hope you enjoyed the first half of today's event. Big thank you again to Kevin Davitt from the NASDAQ for explaining the ins and outs of volatility indexes. I'd like to welcome our next two special guests from OptionsPlay to the call, Jessica Inskip and Tony Zhang. Jessica is the Director of Product and Education at OptionsPlay and has been a prominent figure in the online brokerage industry for the last 13 plus years. She specializes in options and derivatives, and her main passion is investor education. And Tony is the Chief Strategy Officer and co-founder of OptionsPlay with over 16 years of experience as a market strategist in equities, FX, and derivatives. Over the past 10 years, he's built OptionsPlay into a global financial services data platform powering some of the world's largest banks, brokerages, wealth management firms, and global exchanges. You can also see Tony and Jessica as regular guests on TV on CNBC's Options Action Show, where they discuss popular options trading techniques and help demystify this crucial corner of the market. We're very excited to have them here to present the second half of our event today. And with that, I'd like to pass it off. Thanks again.
Thank you so much, Jonathan, and thank you so much for Questrade on hosting this fantastic event. And thank you to Kevin for giving everyone a really strong introduction to the NASDAQ-100 Index and volatility. And what Jessica and I are going to do is carry this forward and giving you a better understanding of option strategies that you can utilize in this type of market environment. So first of all, I just want to welcome Jessica to joining me during this special session where her and I will give you a deep dive into index options, how they differ from stock and ETF options, and then some of the option strategies that you can trade in this type of volatile market that we're currently in. So Jessica, welcome.
Thanks for having me, Tony. Always love doing these sessions with you.
Fantastic. So before we go ahead and get started, as Kevin said before, it is important to understand the risks and characteristics of what you are trading. And when we're talking about options, options carries a level of risk that is different from trading equity. So it's important to understand those risks, and it's important to understand that what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we will use as educational sessions during today. So what we're going to cover today is a good swath of what you're going to need to understand to better trade index options and understand how they differ from stock and ETF options. And then Jessica and I will do a deep dive into two of the most popular option strategies that you can utilize to take advantage of a directional view that you have in the broader markets, but do so in a way with limited risk. And the key here is that limited risk factor, because as markets get more volatile, not only do your profits and loss swings become larger, but also your emotional swings can go from elation to really kind of being really quite down in very fast, very quick amounts of time. And for those of you that are trading the FOMC announcement today, you might be in that same boat where markets reacted very positive initially, and now we're down, almost 3% here on the day. So this market swings are very quick. It's important to understand how you can utilize options, not as necessarily a way to leverage your capital, even though that is absolutely something that you can do, but more so as a tool that can help you reduce your risk. Make sure that you understand how to position yourself so that you don't take on significant losses when you're trading in these types of volatile markets. So let's go ahead and get started. And what we're going to kick this off with is Jessica's going to give you a quick review of what is an option. And this is for those of you that are newer to options trading to get a better understanding of the option contracts that we're going to discuss here today. She's also going to give you a brief overview of equity options versus index options, what the key differences are, and why you might want to take a look at an index option, even if you're comfortable trading with ETF options, what those differences are. And then I'm going to walk you through the NASDAQ-100 Index complex, showing you the different products that you have at your disposal that allow you to gain access to the products and indices that Kevin just spoke about, but doing so in a way that is sized appropriately to your portfolio. And then Jessica and I will do a deep dive into, like I said, two of the most popular strategies that you can utilize in this type of market environment. Now, I'm going to give you a brief overview of, once you're in those types of option strategies, what type of metrics you should look at to understand how you want to manage those trades. And then at the end, we'll open this up for Q&A at the very end. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to what are the opportunities and strategies that you can use specifically in a volatile market using index options. So to kick things off, what I'll do is I'll let Jessica introduce what is an index option, giving you an overview of the option contracts, and then so that you can better understand the rest of today's session.
Yeah, thank you, Tony. And I see a lot of questions as far as what are study guides, and perhaps you're newer to options. So we like to start with just giving you those overviews from an educational perspective. That way you're not completely lost along the way. So an index option, or an option in general, is essentially just a contract. And with any contract, you have a buyer and a seller. And those contracts tend to have terms associated with it, which are what product is this contract containing, how long is this contract good for, what price is this contract good for, and then what am I paying for that contract or selling. So let's put that into terms. So the product in this case is an index option. That's the tradable product. The price is the strike price, and it's issued as a call or a put, which means it contains the right to buy or sell. So a call means right to buy, put means right to sell. I like to even put those together, as in when you say I'm buying a call, that means I'm buying the right to buy. But if I'm selling the call, I'm selling the right to buy. And then that really puts it into context, as in the buyer is paying that premium, the seller is receiving the premium. But then that makes you think about the goals that are associated with that contract. So if I'm a buyer, that means I want that contract to have as much value as possible by the expiration date, preferably before that expiration date, because I can execute upon those terms of the contract. Whereas the seller, they're obligated to fulfill those terms of the contract, which means since they're receiving that premium, their goal is to keep that premium and they do not want to fulfill the terms of that contract. So in a high level, that's really what an option is. And we're just going to zone in on that product type, index options, which has a little bit of different components and certainly some advantages to it that we'll talk about today.
And I just want to add before Jessica moves on to talking about, ETF versus index options, if you look at a page like this and you're thinking to yourself, this looks like a lot of legal jargon, it sounds a little confusing. Remember that it actually is legal jargon because it is a legal contract between two parties. And so today what we're hoping to do is not only show you, what this legal contract involves, but give you a real understanding as to how you might want to utilize these types of contracts in your portfolio to your advantage while doing so with limited risk.
Mm-hmm. Yeah, so let's talk about equity ETF options. So they have the same characteristics. That's why we put them together versus index options. So an ETF option, those are what we like to call American style. And I know Kevin touched on this earlier, but those are physically settled. So meaning if you have a contract on QQQ and you want to execute upon those terms of that contract, so you have the call, you're the buyer, you say, I want to buy at the strike price, you would physically receive 100 shares of QQQ in your brokerage account upon exercising. Now, an index and ETFs are designed so you can trade an index because you cannot physically go buy an index because it's a compilation of a lot of securities that I'm sure you learned through Kevin's session. And so as you probably could take full ownership of everything within that index, it's impractical. And that's why they're settled, most of them European style, which just means cash settled, where you get the difference of the value. And that's when we, in our earlier sessions we've done with Questrade, where we talk about in the money versus at the money and out of the money. That's how they're settled. We've got examples and we'll talk about that as well. But that's the one huge difference is settlement style. So I'm not going to receive the shares or short the shares. Shares are not exchanged. Only cash is exchanged when someone wants to execute upon the terms of the contract, and then you're subsequently assigned on the sell side. Now, what that does is it eliminates one thing, is early assignment risk. And that's because index options normally have a set time frame in which they can be executed upon because of that lack of delivery of physical shares. And because of that, your ex dividends that you have to worry about, or something being very deep in the money, that early assignment risk is eliminated because the person who purchases that contract can only execute upon it within a certain time frame, which is normally the day of expiration. And then of course, since it's cash settled, it makes more sense just to buy to close or sell to close those options on the open market, which is normally what happens, which we've talked about extensively in our earlier sessions. The multiplier is essentially the same. So one contract for equity ETF options represents 100 shares, or now, since we're looking at cash settlement for index options, one contract is just 100 times the value of that index. And then we've got some examples here at the bottom just of the difference. So if you have a long ETF equity call with a strike price of $290 on the triple Qs, and it's trading at $10 and QQQs at 300. So since it's a long means purchase, so I've bought a call, purchased the right to buy. If I purchased the right to buy at $290, it's trading at 300. That means it's worth at least $10. So that's where we see the call is in the money by $10. If you were to execute upon it, you'd buy the shares at $290, immediately sell at the market at 300. So that's the value of 10. Now, if you look at the X&D option, which is the index equivalent, and that's trading at 110 versus the index 120, same applies. It's in the money by $10. So the purpose of showing you this is you can derive the same exposure via index options or equity options and movement in the underlying security. Just the underlying components that make up the terms or that legal jargon are different, and that variation is cash settlement versus the physical securities that are available, and the multiplier versus cash for 100 shares.
So hopefully this gives you an understanding of kind of the difference between the ETF, which is very similar to a stock option in terms of that it's physical delivered, and how that's different from index option. So let's talk a little bit more about index options. So Jessica first talked a little bit about the fact that there's no assignment risk, or rather, because of the fact these are European cash settled options, that means that these are, you cannot exercise them early, which is advantageous for certain strategies, especially as an option seller, where if someone was to exercise a call or a put that you've sold early, then you have to deliver on those terms before the expiration of the contract. And generally speaking, as an option seller, you want to avoid those risks. Now, when you're selling a call or a put on a stock or an ETF, you have that risk. And there's nothing you really can do to mitigate those risks other than potentially rolling early and doing certain things, but largely you don't have control over those specific risks. So when you trade an index option, you can trade them an index option that tracks the same index as an ETF option, but you can eliminate that early assignment risk by trading the index versus an ETF option. So that's one of the main, in my opinion, as a trader, the true advantages of an index option. And Kevin spoke about this a little bit before. The second thing I want to talk about here is the fact that index options are typically listed on indices that are very liquid and diversified in terms of the underlying. So the NASDAQ-100, we know, has the top 100 non-financial stocks listed on the NASDAQ-100. This provides you with not only exposure to, as Kevin says, an index that represents the 21st century economy, but also an extremely liquid and diversified index. And what that simply means as a trader is that you're going to be able to trade these products very easily, especially as a retail trader. Remember, the NDX, or the NASDAQ-100 Index, has about over $100 billion in turnover or notional volumes traded a day in this specific one product. So when you're trading as a retail trader, trading a few tens of thousands of dollars, even hundreds of thousands of dollars in a single clip, you're not touching anywhere near the liquidity of that product, which gives you the ease of getting in and out of a contract relatively easily. And from my perspective, one of the main components of these types of strategies is the fact that when you're trading these strategies on an index, you're diversifying away single stock risk. Single stock risk is really those gaps that you see that happen, overnight, or usually due to an earnings or some type of news event that happens overnight. And what you see is that there's a huge gap between the price that a stock closes at and where it opens up the next day. And that is potential profit or loss, depending on which side of the coin that you're on in terms of option strategies. And a lot of times those gaps come completely unexpected. News or comes out overnight that you did not expect, or you can't possibly anticipate, that has a significant influence on the P&L of your strategy. By using an index, you're diversifying away that single stock risk. And that sometimes can be, again, advantageous to be as an option seller. And then, but there are some, in my opinion, some limitations to index options as well. So first of all, there are only so many broad-based, very liquid indices that are tracked in the US and in Canada. So right now in the US, we see only about 50 indices that have index options listed on them. So you have a much smaller selection for available indices that you can trade index options versus ETFs that span over 700 ETFs right now that you can trade ETF options on. So you do have a smaller selection. And on top of that, index options tend to be much larger in size. If you think about SPX or NDX, these are very large indices, in the thousands of dollars or tens of thousands of dollars in terms of index value. When you put 100 multiplier on these are very large in size. So these contracts, historically speaking, were really built for institutional investors and didn't have accessibility for most retail investors. And that's why I want to spend some time and walk you through the NASDAQ-100 index complex, because the NASDAQ-100 index is an $11,000 index as of today's close, just shy of $11,000. So if you apply a 100 multiplier to that, that is a $1.1 million notional contract. Again, that is an institutional size contract. It was a contract made for institutional traders, generally speaking, in my opinion, not suitable for retail. But there are also two other index options listed on the exact same index, which is NQX and NDX. And NQX is 1/5 of the value of the NASDAQ 100, and XND is 1/100th of the value of the NDX, NASDAQ 100 Index. And so what you basically can do is you take $11,000 divided by 5, and that's how you get NQX, or divided by 100, and that's how you get XND. So NQX, as of today's close, is around $2,200, and XND is $110. Remember, these three indices track the exact same index. They're just different sizes. So this was built so that regardless of what portfolio size you have, you can find the contract that fits your portfolio. So in the context of today's session, we're mostly speaking to most of you are retail traders. You're most likely going to fall into this particular camp of XND. And keep in mind, for those of you that are familiar with trading the NASDAQ 100 index, if you've never used an index option before today, you're most likely using QQQ, which is the most widely tracked ETF that tracks the NASDAQ 100 index. And as of today's close, QQQ is around 275. So what you have is really these two options as a retail trader that give you access to the NASDAQ 100 index in what I would call a retail-friendly size. But XND now makes it even more flexible for you with a $110 contract versus a $275 ETF, because you can always trade multiple XND contracts to equal roughly one QQQ. So 3 XND contracts will roughly be the same size as a QQQ contract, but you can't unfortunately break up a QQQ contract into 3 parts. So this really gives you more flexibility. If you're trying to trade, let's say $50,000 of notional value, you can trade 5 XND contracts. You can't really trade 1.5 QQQ contracts. So this really just gives you a lot more flexibility in addition to the advantageous aspects that we talked about in terms of index options. And one thing I do want to point out here as well is that when you're trading the full value institutional products, and this is the case for NASDAQ 100 index options and many other index options from listed on other exchanges, is that the full value indices many times have also what we call AM settled options. Now, if you're a stock or ETF investor, you're pretty much only familiar with PM settlement, which means that the options settle based on the closing price on the Friday expiration date or the expiration date itself. Index options have an interesting feature where some of them, especially the monthly NDX options, are AM settled. What that means is that they cease to trade the day before expiration, and they're settled based on the opening price on the expiration date. Now, that is a little confusing, and it does mean that you're adding more risk to the trade because you have overnight risk. You have to stop trading on Thursday, but you have to wait until Friday's opening to understand whether you made money or whether the money, how much profit or loss you have on the contract. So whatever fluctuations that happen overnight in that index, you have to accept that risk. So this is one of the things that the smaller indices that are, again, focused more so for the retail offering, XND and NQX, only offer PM settlement so that it aligns with what you might be currently familiar with equity and ETF options. So hopefully that gives you a good understanding of truly the difference between ETF and index options and what are the different products that you can trade listed on the NASDAQ 100 index. So now let's shift our focus a little bit to talking about trading these products, right? So we've introduced the products, the benefits and limitations. Now let's talk a little bit about the mechanics of trading these index options. So I'm going to talk a little bit about, the fact that when you're in more volatile conditions like we are right now, and VOLQ is one of the ways that you can measure how volatile markets are, when things get more volatile, what can you do with your index, with your options trading that can help you adjust to the current volatility? So the first thing I suggest is that when things get more volatile, you might want to reduce your time horizon. So the amount of time that you are looking forward to gain a directional view. You might have a better understanding as to where you think markets will be in the next 2 to 3 weeks rather than 2 to 3 months. So adjusting your timeframes can help you, focus on kind of where your short-term view is on the overall market. The second thing I think it's important to do in more volatile markets is to use a spread. And for those, being that we're doing the session here at Questrade is one of the few Canadian brokers that allow you to trade multi-leg options in this types of in Canada. So what we're going to talk about here today are some of the strategies that you can use that use spreads that can either offset your cost or risks and at reducing your overall risk on the trade itself. So what we're going to talk about is how spreads can really be used to reduce risk compared to outright buying an option or outright selling an option. And then most index options have this unique characteristic of eliminating that early assignment risk, which is key for when you're trading in volatile times. You might find the fact that once you open a contract, markets are whipsawing back and forth, where one day you're profitable, the next day you're not profitable. So when you're using an index option, what you're doing is you're eliminating that possibility that when markets whipsaw one way, that you could get assigned early on an option that you're short by simply trading an index option versus an ETF option. And the last tip that I have for you in volatile markets is that think about scaling in and out of the trades as opposed to being all in or all out of a directional view. This way you can take a directional view, but not necessarily commit the full capital that you were intending on for that specific trade all at once. You might want to wait and scale into the trade. So if markets are rising and you want to fade that move, you think they're going to fall back down, don't just enter your entire position at once. Maybe enter half the position, and then perhaps the next day the market is very volatile and moves a little higher, you can enter the other half. This way you can have a choice and you're not just all in and all out, because sometimes when you're all in or all out, you might find yourself being stopped out a little too early or taking profits too early. By scaling in and out, you can really take advantage of the broader moves of the market. So with that, hopefully that gives you an understanding of kind of the adjustments. What I want to do is give you now a deep dive into two of the most popular strategies that you can use in volatile markets. And then I'll have Jess walk you through a credit spread and a debit spread. And then I'm going to show you a real example of this using the OptionsPlay platform.
Yeah, and great overview as always, Tony. And so we talk a lot about strategy drivers, and I really hope some of you guys attended those previous sessions as we got into depth. Those are really those foundational elements that are essential for what we're talking about. So we're talking first about credit spreads. And that simply means that you sold the entire strategy. So I'm receiving a credit. And the strategy driver, which you'll notice on the screen, is that option contract that is sold. So that means the goal of that strategy is essentially for those contracts to be worthless. We don't want them to have any value. So starting with the bull put spread, and you also notice the profit and loss charts. Now you may or may not have seen those before, but I do love to describe those as well. They're a really good indication of if something is bullish or bearish, and if that profit potential is capped or not. So as you see the profit and loss chart on the left side, there is, it's red, and then on the right, it's green. That means as the option goes up from left to right, that it goes up in value. So that tells me immediately that it's bullish. That's literally as simple as it is. And if there is a flat line from that upward potential, then that means that either my risk is capped or my gain potential is capped, which is true in both of these scenarios. So for example, on the bull put spread, we would construct this first by shorting our put. That's our strategy driver. That's the higher strike. And remember, if I sell, that means if I'm short, I sold, I'm receiving a credit, and put means the right to sell. Yes. So I am obligated to buy in that scenario. And if something has the right to sell, I don't want it to have any value. So I want the underlying security to be higher than that short strike. I then buy a put at a lower strike, and what that does is it caps my risk potential. So individually, a short put has substantial risk potential because if the underlying security does go down below my strike price, I'm required to buy those shares. And when you buy those shares, the most that you can lose is the amount that you spend, right? And so what we do is, I think if you go to the previous slide, Tony, you went to debit spreads real quick. Thank you. So the long put strike, what that does is it gives me a predefined sell point. And if I'm obligated to buy, that way I cap my risk potential. So that's essentially the purpose of it. So with the strategy driver, you'll notice that this is a 50 delta, and we talk about deltas quite often, and they mean so many different things. But in this case, it's probability of expiring worthless on expiration, and there are different variations based on when we do this. Now, something with a higher delta means it's closer to the money, and something with a lower delta means that it's farther away from the money. So something with a higher delta is also your strategy driver. The more expensive option is also your strategy driver. And that just means that that individual contract is what, or component is what's really the goal of the strategy. Everything else, at least in the case of credit spreads, is risk mitigate. So for the bull put spread, I am collecting a credit. The goal is for the underlying security to go above my strike price. The bear call spread is just the inverse. So this is where I'm selling the call. I just want the security to go down in this scenario. And Tony's going to bring up the tool where we talk about optimal environments and some real life examples, but the same rules apply here. But the intent of buying the individual leg is purely for risk reduction. So a predefined sell point on the put side and a predefined buy point on the call side. And credit spreads, normally, since we're selling and that's the strategy driver, if you've attended the session where we talked about options pricing, you'll know that a component of options pricing is implied volatility, time value, in addition to executable value. So in times when implied volatility or volatility is heightened, that means options are more expensive, which means if something's more expensive, that's when we would prefer to sell it. So, and we'll of course give you some real life examples, but I did see a couple questions on what's right and what type of environment. What's important to know is what sentiment does your strategy contain? So these are both have a directional bias of bullish or bearish, so bullish on the put side, bearish on the call side. It is technically neutral to bullish on the put side and neutral to bearish on the call side because the options or the short options in either case are considered worthless as long as it's least a penny in the money, which is the goal for the overall strategy, which means you don't need a huge directional move to be profitable. You really need volatility to come down and you need time to decay and the security to move just a little bit in your favor, but it can also be neutral depending on your strike selection, which is why we say the 50 delta, which should be right at the money. So at a high level, it's a bull put spread and a bear call spread. What I want you to take away is the strategy drivers are the sell side of the options. And your goal is for the strategy to really not have any value. You don't want your calls to have any value. You don't want your puts to have any value. So the way for puts to not have any value is it's more advantageous to sell at the market, whereas the call side, it's more advantageous to buy at the market versus the strike price. And then we can flip it over to debit spreads. So debit spreads, it's just the opposite. And this is the one presentation we didn't show a T-chart, but if you've seen that before, this should really put it all in perspective. So now the strategy drivers are the options that we're buying. Now, whenever you're buying an option, you are very directional. You need a sharp directional move. For the call side, you need it to go up. So in your favor, the put side down. And that's because of that pricing component that I was talking about. So since an options premium is comprised of executable value, which could not be there, because if you have the right to buy at 100 and then the market's at 90, that's zero executable value because I can go buy at the market at 90. But then it's also made up of time value and implied volatility. So time is going to be working against us as we're buying the option, which means it's something we need to overcome. We're buying time, which means we can sell to close time. But that also means because we have to overcome it, it's largely directional. So we need a sharp directional move in our favor in order to be profitable. And that's because we want to compensate for the time that we've purchased and, of course, implied volatility. So that's the huge difference that I want to make sure you remember is on the sell side that I can be just neutral and directionally biased. Whereas if I'm buying options, I have a very large directional bias and I need a sharp directional move in my favor. For the call side, for it to be worth something, it needs to go up, for the put side to go down. Now, the purpose of selling the options in this case, it just caps your profit potential. So if I have the right to buy a security at 100, and it's a call, this is going to be my strategy driver. In order to cap my profit potential, what I do is I give myself a predefined sell point, really. So I'm sell a call at a higher price. So since that call contains the obligation to sell, what I do is I cap my profit potential based on that higher strike. And again, if you saw or recall what I said earlier, the strategy driver is always going to be that more expensive option, that option with the greater delta. That holds true because this is going to have a much higher strike price, and buying at a lower strike price is much more advantageous than this one. So the purpose of adding those directional moves, so higher strike on the call side, lower on the put side, we're going to sell those, and that's going to reduce my risk exposure, which is the amount that I spent. So the exchange is capping my profit potential in exchange for paying less, but that helps you if you think about what I said earlier with that sharp directional move that's needed. You do pay down or receive a credit for some of that time value that you're purchasing, which means if it doesn't move as much, you've really reduced your risk exposure in that case. And then the inverse is true on the credit side. So the purpose for debit spreads is let's cap profit potential, reduce risk exposure. On credit spreads, let's mitigate risk exposure in exchange for less of a premium, but there is substantial or unlimited risk exposure in the case of a short call, substantial and a short put. So the purpose of these are simply that. And Tony, if you want to bring up the options play tool, we'll give you some real examples, and that will really put everything together and in perspective.
Yeah, thank you so much. There's a few things that are important to understand between debit and credit spreads. And one of the most common questions that we get is, which one should we choose? Should we trade a credit spread or a debit spread? And the answer is it depends on your outlook. And I want to explain what that means, what the pros and cons of these strategies are of each one, and when you should use credit spreads and when you should use debit spreads. So I'm going to use XND as an example, and this is the OptionsPlay platform. And I'll show you in a few minutes how to access this platform if you've never seen it before. But the OptionsPlay platform automates both credit spreads and debit spreads for any stock, ETF, or index in both US and Canada. And this allows you to quickly take what you've learned here today and apply them and actually see analytics so that you can understand you can understand the potential risks, the potential rewards, and whether or not it's a strategy suitable for the outlook that you have for that specific index. So let's take a look at XND. XND is continuing to trend lower here. We know on the back of the FOMC meeting today, it is breaking lower. Perhaps you think that XND can revisit that 105 level here to the downside, which was the lows back here in October. So if you're thinking to yourself, XND will likely revisit the 105 lows, let's take a look at selling credit spreads, and then we'll also take a look at some debit spreads as well. So I'm going to use the high implied volatility setting in OptionsPlay, because when you use the high implied volatility setting, we're going to bring up both the bull put spread as well as the bear call spread in an automated fashion. So Jessica told you about the construction of these strategies. Now you can do this manually by pulling the options chain. You can modify it. You can click on the specific expiration dates. You can choose the strike prices. but OptionsPlay does all of the work for you by automating it so that we're taking best practices in terms of choosing expiration dates, specific strike prices to sell, specific strike prices to buy, and giving you a starting point. So if you've never seen a credit spread before, you can click on any stock that you'd like to. I'm going to use XND, the NASDAQ-100 Micro Index Option, and I'm going to look at credit spreads, and it'll construct the credit spread depending on whether I'm bullish or bearish in the markets automatically for me. So because we're looking at we're in a bear market, we've seen the FOMC reaction to the markets today, I'm going to take a bearish bias, but you can take whatever view that you like, and I'm going to look at selling the call credit spread, the bear call spread. Now, one of the things that you're going to notice here with any type of credit spread is that the potential reward, in this particular case, $229, is always going to be less than the max risk. So in this particular case, $671. So that's one of the key characteristics of a credit spread, is that what you can potentially make is always going to be less than what you're risking. And many investors will ask, why would you ever trade something with a negative risk reward ratio? Well, the answer is because the probability of profit is relatively high. You see, the probability of profit is 60%. And I think I saw a question here earlier before about, when these strategies are profitable. So we're going to use our P&L simulator, and we're going to see how credit spreads evolve as the stock or the index in this case moves in your favor or moves against you. So let's say the index does move in the directional view I expect it to. Let's say it goes down to 105. What I can do is I can use my P&L simulator and say, what happens if the index moves down to 105 at expiration? What is my potential profit? And what you'll see here is that you can potentially make $229 in profit if the index moves down to 105. Now, that's not surprising because what you were expecting the market to happen does happen, so you make a profit. Obviously, this makes sense. Now, there's two other scenarios that can happen after you sell a credit spread. The market can go in the direction you expect it to. The market can maybe move sideways, or the market can move completely in the opposite direction. So let's look at all three scenarios as to what happens. So let's say, what happens if the market just stays where it is at around 109? As you can see here, if the market just stays around 109, or rather 110, because we're closer to 110 right here, as you can see here, I still turn a $229 profit. So that's really one of the key components of a credit spread that's advantageous to a lot of investors, is that even if the index or the stock doesn't move in the direction that you expect it to, but it just simply stays where it is, you still turn a profit. And you actually turn the full profit, not just some profit, but the full profit. Does that make sense, everyone? Please type 1 into the chat window, or maybe into the Q&A window if you're looking at this right now. Because that's really one of the key components of a credit spread. And that's what's attractive to a lot of investors, is that that you have a directional view, you want to express that directional view, but even if you don't get that directional view right, you still make the same profit as if you did get the directional view right. And then it gets even a little better, is that you have a little bit of wiggle room. If the stock moves, or in this particular case, an index moves in the opposite direction you expect it to, let's say it moves up to 112, guess what? Not only do you not see a loss, you still turn a profit. You just don't turn a very large profit, but you still have a profit because you have this buffer, a buffer of $2.29 against the direction that you expected to, because that's how much premium you collected. As long as the index doesn't move by more than $2.29 against you, you'll still be able to turn a profit. That's the true, quote unquote, forgiving nature of a credit spread. Now, there comes a trade-off with that, right? And that trade-off is the fact that if the trade does go in the direction or in the opposite direction that you expect it to, let's say it reaches back up to 120. What you can see here now, what you can potentially lose is going to be greater than what you can potentially make. That is the trade-off that you're making with a credit spread. And I hope that you can understand that, because I get a lot of questions from investors asking whether I should trade a credit spread or a debit spread. And the answer is that it's not simple. It depends on your directional view. And what I tell investors is that if you have a mild directional view, right, you just see that the stock or the index that you're trading is trending in one direction, you're not convinced that it's going to drop sharply in the next month or so, trade a credit spread, because this gives you a more forgiving nature to the trade that you're making. But if for whatever reason you're feeling pretty strongly about the fact that this index is going to make a fairly sizable move to the downside in a quick amount of time, right? Maybe you're thinking to yourself, this earnings season is already turning out to be quite poor. Analysts are going to revise earnings lower here, but before we even get to the end of the year for Q4 and into 2023, and that's going to potentially have stock prices tumble. And I think that's a very reasonable assumption to be making. Maybe you're thinking before the end of the year, things could turn to the point where I think things could be materially lower than where they are today. Well, that's really where, in my opinion, that you might want to take a look at a debit spread. So let's take a look at what a debit spread looks like. And OptionsPlay, again, also automates debit spreads as well. So you can either select I'm bearish and see the bearish debit spread, or you can select I'm bullish and see the bullish debit spread. Now, given the environment that we're in right now, I'm going to take a look at the bearish debit spread. And what you can see here is I'm going out to December. I'm buying the 110, selling the $99 put option. And that's going to cost me $332. And the key characteristic of a debit spread is the opposite of a credit spread, which is the fact that what you can potentially make is going to be greater than what you're risking. Does that make sense, everyone? Give me a big thumbs up if that makes sense to you. Because when you're trading a debit spread, your risk to reward ratio is going to be positive. But the trade-off of that positive risk to reward ratio is the fact that your probability of profit is going to be lower. As you can see, the probability of profit here is only 39%. And I get a lot of questions from investors asking, why would you ever trade something with a low probability of profit? I want something with 90% probability of profit. But as you learned before in the credit spread example, when you have high probability of profit, then you have a very poor risk to reward ratio. When you have a low probability of profit, you have a very strong risk reward ratio. And again, one is not better than the other. It depends on your outlook of the stock or the index. So in this particular case, if let's say the market gets back down to 105, which was my initial expectation in the previous example, what you see here is that I'm risking $332 to make $168. So I do turn a profit, but not a very strong profit versus the credit spread. I was making $229. Here, I'm only making $168. So if I expect that the index is going to move a small amount to the downside, I'm only going to make a small amount of profit. But if I do expect the index to move a substantial amount, so the one standard deviation move, and Kevin in the previous session talked about standard deviation moves. If you expect that the stock is going to make a normal size move to the downside, which is about $99 to the downside between now and December, based on current implied volatilities, look at what you're risking or what you can potentially make off of the $332 that you are risking, $689. You're making double what you were risking in this particular case. And that is the case for a debit spread. So only if you expect that the index or the stock that you're trading is going to make a big move to the downside within a short amount of time, that is when the debit spread is going to give you a better return on your capital for roughly the same amount of risk. Does that make sense, everyone? Give me another thumbs up if that makes sense to you. Perfect. Okay, so hopefully that helps you better understand the difference between a credit and debit spread and when you might want to use it and how to use the OptionsPlay platform to find these specific strategies. You can type in any symbol, click on bullish, bearish, or high implied volatility. It will automatically construct the debit or credit spread to help you do this analysis and better understand which one's best suited for you. So in the few minutes that we have left, I do want to talk a little bit about managing these types of trades. So whenever you sell a credit spread, you're always going to be collecting a specific amount of premium relative to the width of the credit spread. And the width of the credit spread is simply the distance between the two strike prices. So in this particular example, if I collect $4 of potential income on a $10 wide credit spread, there's a lot of questions around how do you manage this? And the rule of thumb that we generally have is that once you've made 50% of the potential max profit, it's time to take your profits and move on to the next trade. So if I sold something for $4, that's the most I can make. Once I make half of that, which is $2, I want to take my profits and move on. So what you want to do is you want to put in a limit order, for example, at $2, and that allows you to buy back the credit spread that you've sold for $2 and make 50% of the gain, and that's your take profit order. Now, if the trade starts to go against you, the rule of thumb that we typically have is that once you've lost 100% of the max gain, so if you can potentially make $4, once you lose $4, then it's time to cut your losses and move on to the next trade as well. So that means that if you sold something for $4, you might want to put a stop order at $8, because if you sold something for $4 and buy it back for $8, you've lost a total of $4, and that's 100% of the max gain. Does that make sense, everyone? Give me another thumbs up if that makes sense to you. And lastly, in terms of debit spreads, this is fairly easy to manage as well. Debit spreads, what you pay is the most you can lose. So if I pay $3 for a $10 wide debit spread, then what you generally want to do is you want to take profits at 75 to 100% of the max loss. So once I've paid $3 for something, once I've made 75 to 100% of that premium, I want to start taking profits and moving on to the next trade, and vice versa. If I lose 50% of the max profit or the max loss, so the $3 that I pay, once I lose half of that, $1.50, that's when I want to cut my losses and move on to the next trade. So these are rules that you should have in place whenever you're trading spreads, even though spreads in itself already define the potential profit and loss, that these can further improve your returns by using these types of rules to cut losses sooner than taking the full loss, and also making sure that you have rules for taking profits. So with that, I'll just wrap this up by talking a little bit about position sizing and scaling in and out, which I touched up on earlier. Position sizing, this is arguably more important than anything else that I've taught here during today's session, which is calculating how much you can risk on each individual trade. You know, if you've ever been in a position where you said to yourself, man, that was a really bad trade, I lost a ton of money. Most people will point to the trade itself. They'll say, I made the wrong analysis, I looked at the chart wrong, or I followed the wrong person, but that is never the problem. If you say that, man, that was a bad trade, I lost too much money, the problem is the sizing that you had on that particular trade. You traded too large of a size, because you can't control where the market goes, but what you can control is how much size you trade. And if you trade your sizes, accordingly and appropriately, no matter how bad, quote unquote, a trade goes, you will define that risk. So the rule of thumb that we have as professionals is that you never exceed 2% of your total account value per trade. So the max risk of any single trade, and when you're using OptionsPlay, we always display to you your max risk. The max risk for the number of contracts that you trade. So if you're trading 5 contracts here, you see that the max risk is $1,660. You need to make sure that that never exceeds 2% of your total account value. Because if you do that, no matter what happens, even if the trade goes in the exact opposite direction the second you get into the trade, and it was the worst trade you've ever made in your life, you still have 98% of your capital left to continue trading. And you'll never be in the position saying, that was a bad trade, I lost a ton of money. You can't control the first part, but you can control the second part. Does that make sense, everyone? Please type or give us a thumbs up if that makes sense to you. And the second rule that I have is never add to a losing position. If you have a losing position and it's not working out, cut your losses, move on to the next trade. It doesn't stop you from entering another trade in the same stock, maybe a day or two later, but that should be a completely separate decision than the fact that you have a losing trade from adding to that position. And just talking a little bit about scaling in and out, when things are very volatile, you don't want to be in that position where you're forced to make a decision to be all in or all out of a trade. You might want to say that, hey, I think market's going to move lower. Instead of risking 2% of my account on this trade today, I'm only going to start the position with only 1% of my account. And then if the market starts to move in the direction I expect it to, maybe I add to it. Or maybe if the market starts to move against me, I can take the other half and dollar cost average, if you will, into that trade. This way, you're not fully in or fully out necessarily at once, and you're not getting stopped out or taking profits all at once. You know, especially when you experience getting stopped out and the market goes back in your favor, this is to help prevent that, because perhaps only half your position gets stopped out, and then the other half you can maintain for the rest of your portfolio. So with that covers what Jessica and I wanted to share with you today, to give you a full overview of trading index options in a volatile market, the type of strategies that you can trade, and the tips that we have for helping you navigate this type of market with these types of option strategies. So with that, what I'll leave you with is just how to find out more. And this is something that Kevin already showed you before. If you want to find out more about the NASDAQ-100 Index Option ecosystem, you can go to trade.optionsplay.com/XND to find out more. And you can always find out more about OptionsPlay at optionsplay.com if you want to learn more about what Jessica and I have to offer, as well as how to access the OptionsPlay platform. So with that, what I'll do is I'll turn that back to John for a quick Q&A session in the few minutes that we have left.
Perfect. Thank you so much, Tony and Jessica. I really, really appreciate that in-depth explanation, the OptionsPlay platform demo as well. This has been extremely helpful. Just bear with me one moment while I pull up all our Q&A questions here, and we'll tease them off. Perfect. All right. So I think I'll address the very first question that's been sitting here for a little while from one of our participants here, Pauline. And I think we've already addressed quite a bit of this, but should we trade options in this type of market that we're going through today? Maybe some of the unprecedented rate hikes we're seeing, some of the volatility. What would maybe be a quick soundbite, answer that either of you can provide?
From my perspective, I think in a volatile market, one, you have to make sure that using spreads is a way to help protect you. And we talked a lot today about risk mitigation, right? Using spreads is one of the primary ways that you can mitigate risk. Position sizing is also really important in this type of market environment, and scaling in and out gives you a little bit more flexibility. So that's my advice, and I'll pass this on to Jessica if she's got anything to add.
Yeah, I completely agree. And I think in this type of environment as well, it behooves you to layer on technical analysis as well, just to find those areas of supply and demand. And that can certainly help with optimizing your strike price selection and directional view as well.
Absolutely. I think I'll second that thought, Jessica, as well. I'm a big believer in following the support and resistance levels and doing some TA before entering any kind of trade. But everyone I know has their own opinions on technical analysis. Awesome. So let's move on to a few more questions here before we wrap things up as we approach 5 o'clock here. Got a good one here. So how should one maybe avoid, volatility crush when you're buying an option close to an earnings announcement? So maybe this is kind of one-sided. I know we talked about spreads a little bit, but let's say I'm going long. I'm buying an option close to an earnings announcement and it's got high volatility. How do I maybe account for that? Any kind of strategies around that?
Sure. Well, one way is spreads as well, right? So if you're buying an option, selling a further out of the money option is one way to offset some of that volatility crush and offset some of the time decay. Spreads is certainly one of the, I would say, the key areas of what you can do. The other thing that you can do is you can buy a slightly in-the-money option. In-the-money option has less extrinsic value, and because the intrinsic value of the option is not going to erode with the IV crush. And those are the two general components. So what we typically like to do is to use an in-the-money debit spread for an earnings announcement. That's going to reduce your time decay factor and the volatility crush.
By in the money, Tony means the long leg, not the short leg.
That's correct. Thank you for that clarification.
Of course.
Appreciate that. That was a really detailed answer. And I think our participants can definitely take some potential ideas away from that here. I think maybe a bit of a question regarding the OptionsPlay platform, Tony or Jessica, if you don't mind maybe going into a little bit more detail on some of the features that are available, some of the things that maybe set the platform apart, some of the maybe things that it might offer that Questrade's own platforms don't offer.
Sure, I'll do a very quick overview. The platform is really designed to help your to make your options trading experience much more simple and easy to understand your risk and rewards, because that's really the most complex part is how do you pick a strategy? How do you pick an expiration date? How do you pick a strike price? That's kind of the main, I would say, complexity part of trading options. So OptionsPlay, as I showed you in the demo, really shortcuts that so that any stock or ETF you type in or index, you can easily find the strategies that you want to trade. I saw a couple of questions asking if we support, time spreads and calendar spreads. All option strategies are supported within OptionsPlay, and you can construct just about anything you can possibly imagine using OptionsPlay. And then having the powerful tools to actually compare different strategies side by side so that you can say, do I want to to trade a debit or a credit spread? In this scenario, which one gives me higher profit? Which one has more risk? These are the things that you need to know before you make that trading decision. So the OptionsPlay is a support tool for all of that. So that's a quick 1-minute overview of the platform. If you want to find out more, you can find out at OptionsPlay.com.
That's really great. Thank you so much, Tony. That's a great explanation. And I think to maybe add to that from the Questrade side, I would think about the OptionsPlay platform as an accompaniment. It's a great place to go for ideas, to back test, maybe try out some strategies that you're maybe thinking about going into. It won't actually execute your trades at this time. Maybe in the future, we'll see where things go. But at the moment, I would think of it as like an accompaniment app to your main, IQ trading app.
And I saw some questions about education. Jessica and I do education sessions just like this every single Thursday for OptionsPlay members. So if you want to find out more, we do deep dives into specific option strategies just like this. And as Jonathan, one other thing is that you can also paper trade using OptionsPlay. So if you're just getting started and you want to try things out, you can paper trade using our platform.
Well, that's really good to know. Thank you for adding that. All right, we'll do a few more questions as we wrap things up. I saw there was maybe one for Kevin as well, if he's still around, but if not, let's jump into one for Tony and Jessica in the meantime.
I'm here.
Oh, perfect. Let me just ping you to our screen here, Kevin. So I think you mentioned that you wanted to answer the main differences between the index options and trading QQQ options. I know we talked a lot about this already. Maybe if you could just go into a little bit more detail about that.
Sure. I think they were highlighted fairly clearly. Generally speaking, you have different sizing alternatives, a greater variety in terms of notional exposure. The three key differences being cash settlement, with which both Tony and Jessica highlighted, as opposed to physical delivery. The styling being European, so you can eliminate that potential for early exercise, which is not something that most people are concerned about. But if and when it ever happens to you, you likely don't forget it. At least that's the way I think about it. The tax implications I mentioned for those in the US. And then the last thing that was mentioned is the some have third Friday AM expirations. You could look at that as a positive or negative, like whatever, 6.5 hours less dollar risk if you're short options. But that is important to understand. Just like, the leveraged ETF question, you got to understand the product, kind of the contract specs independent of what you choose to trade.
Absolutely. I think the settlement's the main difference for me personally, and whether it's European or American. I think that's going to make the biggest difference in my kind of trading strategy. Thank you, Kevin. Awesome. We'll do one more maybe for yourself that's very similar, and then wrap up with one last question for Tony and Jessica. And it's, are the bid-ask spreads similar between index options and ETF options? I know this is maybe a bit of a loaded question. Are they going to be quite similar, kind of the spreads?
No, I don't see that as loaded questions. Sorry, Tony, do you want to take that one?
No, Kevin, I think this is you should take this one.
All right. So no, I think that's a natural question. I think we look at screen markets and we make a fairly snap judgment. And in some situations, we are used to a nickel or less wide, depending on the underlying, right? In some situations, it's better. Now, that does speak to liquidity to a certain extent. Now, beyond that, I think you do need to adjust for the notional size of the spread. So just using a kind of simple example, the optics on an NDX option spread relative to a QQQ are going to be different, but you're talking about a much different dollar notional exposure. And that needs to be accounted for. Lastly, and it's better to have a third person promote it, OptionsPlay did a really good research piece recently about the propensity for index options, specifically in and around the NASDAQ-100, to be executed within, I think it was 2% or less of the midpoint for over the course of a handful of months. They could elaborate there. But so the bigger picture point here is, by and large, you're probably not paying the offer or selling the bid and working
to get something done as close to mid-market, I think is a great idea. And again, we don't give advice, but like saving yourself there tends to be a good idea. And you are absolutely able to do that in many situations with index options.
Yeah, and I'll just wrap this up in a 1 minute, review of kind of our research. We did. If you think about the bid-ask spread, it's kind of like the sticker price that you see on the car dealership when you walk into the car dealership. It's the advertised price, but what we really care about is what is actually paid. So what are investors actually paying relative to the fair value or theoretical value of what we call the midpoint? And what we see is that 75% of executions happen within 2% of the midpoint. Despite however wide the bid-ask spreads are, they execute within $41 out of a $1.1 million contract. So that is a pretty small effective spread, or what we call a true execution spread, because $41 on a $1.1 million contract is 0.0004% of the notional value that you're paying in transaction costs. So
just regardless some off of the top math right there for everyone.
So regardless of how wide the spreads are, we see that execution quality is actually extremely strong. And that goes back to the $100 billion in notional value that's roughly traded on NDX every single day.
Better answer.
Thank you so much. And I think that just underlines the main point between maybe some of these larger size index products like NDX versus some of the micro cap products that may be more suitable for retail investors. Liquidity is going to be great on both, but at the end of the day, one is more suited for institutional versus retail. Awesome. Well, thank you so much to all three of you guys for coming on today and presenting and sharing such insightful education with our customers and even our leads who aren't yet Questrade customers. Big shout out to the OptionsPlay folks and big shout out to Kevin from the NASDAQ as well. We really, really appreciated having you guys on today. Awesome. All right. So I guess with that, we'll wrap things up. Thank you again, everyone, for attending. And please watch out for the post-webinar survey. Let's wrap things up with a bunch of big thumbs up and reactions for our lovely guest today.
Thank you so much.
Thanks, everyone. Have a great afternoon.